couple of the characteristics that we look for in a bank are capital. Number one, are you strong? Do you have the support? Number two, credit quality. Are your credit metrics continuing to go the right way? And number three, core earnings trajectory. Are you able to drive earnings growth and also adequate returns for your investors? In terms of peer comparisons, we think about the relative valuations that a company that possesses those types of characteristics have against other peers in their group. We also think about how they look at on a return on assets and return on equity perspective versus their current valuation. Well, in terms of how banks trade relative to book value, we think it's a bit of a near-term cyclical issue, but should be resolved over a longer-term trajectory. One of the reasons is that currently return on equity is low, which does justify often a sub 1x tangible book or book value multiple. We think that as the economy improves and eventually as interest rate goes up, return on equity should improve and justify higher book value multiples, and eventually over time we think that should move back to over 1x. If I were a bank CEO and I had the opportunity to ask one of my analysts a question, I would ask about the trade-off between growth and returns. And I think in this day and age, valuations have gotten much more focused on the balance between being able to grow your bank at reasonable risk and also being able to return more dollars to the bottom line. So the importance between balancing reasonable growth but also driving reasonable ROE, I think is an important question. I'd like to know where the analyst community stands.